Good morning. Welcome to Stock Market Today, Thursday, January 28th, 2021. Dan Russo, Chief Market Strategist at Chaikin Analytics. Find me on Twitter at @DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where I get a lot of the content for this show. We also give you daily stock ideas to consider. Hits your inbox every trading day before the market opens. So let's get after it a little bit here. U.S. equities under pressure yesterday. Dow was lower for the fifth consecutive session. Comm services, discretionary, and healthcare were the worst performers. Energy, staples, and tech led the broader tape. Treasuries were stronger, led by the long end, so the curve flattened. Dollar was stronger on the major crosses. So all those kind of themes that we've been talking about, the intermarkets kind of playing out here a little bit. Gold finished down 30 basis points. Kind of fascinating to me that the Fed remains dovish, but gold can't catch a bid. Maybe there's a faster horse out there. WTI crude finished up 50 basis points. As we get to the desk this morning, futures are down 40 basis points after Asian equities were under pressure overnight. Weakness in China as the PBOC liquidity drain continues. European equities are also under pressure. Treasuries are mixed with the curve continuing to flatten. 10-year yields are actually trading around 1% after breaking through that level on Wednesday to the downside. Dollar is stronger against the yen and the euro. Gold down 20 basis points. WTI crude off 30 basis points. And earnings season continues to be a sell the news event for the most part. After the close last night, we heard from Apple, Facebook, Tesla, a bunch of other names. Tesla and Apple both provided kind of some cautious outlooks, which was interesting. But really, I mean, stocks are under pressure last night and this morning. So the sell the news event around earnings continues to be the theme. Remember what we've been talking about here. We've been talking about markets are overbought. Don't be so aggressive. Give it time. Make sure your risk management process is in place. There'll be opportunities to add back. So with that in mind, kind of looking at the structure of the market with one word, patience. Give it some time to play out. Maybe it plays out this morning. I have no idea. I'm looking for oversold conditions within our framework at Chaikin Analytics above key support. What is key support? You know it. It should be ingrained in you right now. 360, 370 is near term, then 340 for SPY, 300 for the Qs, 190 to 200 for IWM. Other than that, the structure of the uptrend remains in place, and we're playing for upside. The question is, again, how do you calibrate your aggression levels, right? Think of it, I always think of it in terms of when to lay back and when to attack. I use the analogy of running. Where I live, it's very hilly. And I like running, but I'm not a great runner. So I kind of tell myself, know when to lay back, know when to attack, right? So when it's an uphill climb, I throttle back my aggression. But when I get to the downhill, I can attack. I kind of view the markets the same way. We're in an uptrend, then the overbought, oversold indicator that I use here at Chaikin Analytics tells me when to lay back and when to attack. That's how I like to think about it. Our market in a minute now. What are we writing about? Stocks retreat led by the Nasdaq. Earnings season remains a sell the news event. I think I hit those pretty hard earlier. Short-term breadth metrics begin to deteriorate, but importantly in my note, not quite at levels that signal completely washed out the way they have in the past. So that's something that I'll be watching for as well. At the same time, we're not oversold yet. We're still actually overbought in the SPYs and the Qs. IWM, a little less so. We're watching the counter trend rally in treasuries and futures, as I said, point to a lower open here today. Now, the major indices took it on the chin yesterday. You can see the Dow down nearly 2%, 10 to 5 bulls to bears. S&P 500 down 2.38%, 126. So solid ratio. Nasdaq actually sees its ratio flip on the day. That's kind of interesting. Let's pay attention there. They were the underperformer. Small caps actually outperformed slightly on the day, but did see some deterioration. First time we've seen this number below 800 in a while. That's probably a function of the technical component to our rating, as a lot of these stocks have gotten hit. Bonds up, yields down. Like I said, 10-year back through 1%. According to the Chaikin Power Bar, small cap stocks are somewhat more bullish than large stocks. Major indexes are mixed. Let's hit our screen of the day, our stocks of the day. Remember, it's Thursday. So we do the bearish side or the potentially bearish side or things you want to avoid. And because it's earnings season, I like to bring a little bit of an earnings component to it. So we're going to look at the Russell 3. We're going to look at stocks that are very bearish and neutral minus and some even neutral. But I want names that are overbought in the near term. I want names that have weak relative strength. You know the importance we place on relative strength. But here's the thing. I want bearish earnings consistency, right? Earnings consistency is interesting because companies that meet or exceed expectations, i.e. do what they say they're going to do, tend to be rewarded. And companies that don't meet or exceed expectations tend to be punished over time, right? As a group, mind you. There are always going to be exceptions. But as a group, that's generally the case. That's why it's a factor in our model. It's one of the 20 factors that we look at, earnings consistency. So if earnings consistency is bearish and a stock is overbought with weak relative strength, do I want to play it? Do I want to look at it? Do I want to potentially think about why I own it? If it meets these criteria, recognize Splunk from yesterday, down nearly 3%. Workday is another name. All right, so take a look at this chart. Take a look at this, screenshot it, add it to a list. If you own any of these names, kind of consider why you own them. Do the work. Figure it out. Maybe you don't want to own them anymore. Maybe you want to take a bearish bet. Maybe you can do that too. It's your game. I'm just here to help, guide, give you my thoughts. Ultimately, it's your call. But I think this is a pretty interesting screen. Take a look at it. Sector tracker now, moving in the last 5 days, only one group higher, and that's REITs. Okay. Staples, comms, tech in the top 4. Utes, describe. I'm just whatever. The market's taking a breather here. The big leaders coming out of the downturn and the cyclical rotation. We've talked about it. Came off. We've been talking about it all week. They continue to come off a bit. I don't think it's over. We'll have to just pay attention a little bit here, see what's going on from a relative strength perspective. Right now, however, it's a mixed bag. So. We've been saying for 2 weeks, the trend is up, but we're overbought. Calibrate your aggression levels accordingly. At the same time, don't make sure your risk management process in place. I mean, look, I had some stocks yesterday, trade through stops in my personal account. And I'll sell them this morning. Right? It's a process. It's mechanical. I don't second guess it. Maybe they snap back. Great. If they set up again, I'll buy them. Maybe I'll buy them higher. Great. I don't care. I have a process. I don't want to own stocks through downturns like February of last year, right? Think about risk management. Think about GameStop when you think about risk management if you were short that stock, right? The reason you have a stop is to make sure you're not short at $10 and covering at 150 and 200. Risk management. Industry in focus, space and defense. I think this one's going to get interesting. But right now it's been an outperformer over the past 6 months, 14.5%. Power bar ratio, very strong. Teledyne, Ducom, and AAR are all bullish. Group's ranked number 10 of 21 subsectors, right? 8 to 2 bulls to bears. But struggling here, struggling at the prior highs. Didn't break you out, little consolidation. Let's see if we can, this is an interesting setup, right? Because cup, handle maybe. If that's your game, if that's what you're into. What I'm looking for is kind of hold 105 to 110, hold key levels, become oversold, and then I'll start paying attention a little bit. We're an outperformer. Money flow is mixed. Neutral rating on the ETF. Trend is strong above the trend line, but a lot of puts and takes. I'm not in a hurry to be aggressive here. My stops are going to put some cash in my account, and then I'll start to look for my setups when the time is right. Let's look at what's trending now. Yesterday's movers and shakers. IRM, nothing company specific. Positive sell side commentary on Seagate sends that stock higher by 10.5%. Viacom, 52-week high, did catch a downgrade today at Credit Suisse. Moffett-Nathanson had some positive comments on Disca, DISCA, up 7.74%. Solid boutique shop in the TMT space, mostly on the media side, worth paying attention to. HPE up nearly 7%. I did not see anything company specific to drive trading in that name today. On the loser side of the brand, spec retail was under pressure yesterday. It's specialty retail. L Brands down 12%, Gap down 10.5%. Microchip, nothing company specific. Those semis were hit fairly hard yesterday. Group was down close to 5% on the day. TXT down 7.5% following their print. Xilinx, nothing company specific yesterday, hit with semis more than likely, down 7.3%. They do report earnings after the close, however, last night. So we'll see how that stock's faring later today. Short-term breadth metrics weaken. So again, we look across time frames and especially from a trend perspective. Longer term, still fine, right? 88% of stocks above their 200-day moving average in the S&P 500. Intermediate term, a little bit of a deterioration. Remember, we like to see over 60 as healthy majority. You start to get down in the 20s and 30s. You're getting washed out. You break below 30, and all of a sudden you have situations like we had last, almost a year ago. So we're breaking down, but not quite at washed out levels just yet. And even, for those of you who read my note, I also look at the percentage above their 20-day moving average, and that really deteriorated this week, ticked down to 28%. However, what's interesting, usually down under 10% on that metric is kind of washed out. So we're not there yet. Advanced decline line rolling over a bit with price as well. So, the game plan. I laid it out for you. Hopefully you weren't aggressive over the past 2 weeks. If you've had some stops trigger, great. That puts some cash in your account. And then when we start to get to washed out levels, you have some cash in your account to put to work, potentially, if that's your process, if that's what you do. So we'll take a look at everything else that's going on in the marketplace. We'll keep it focused. Right now, I'm looking for, kind of washed out breadth, oversold levels, and then, look for my setups. That's how I'm thinking about it. No bid to the miners. This is kind of interesting. And, no bid to gold really either in the near term here. The Fed's been dovish. So there was no surprise from Powell's speech yesterday. Not that anybody was expecting a surprise. The Fed is dovish. They told you they're going to be dovish. They told you they're going to stay dovish. And in that environment, gold's not working. Gold was under pressure yesterday, and the miners are not working. GDX, take a look at the VanEck Vectors Gold Miners ETF. Under the 50, under the 200, your death cross here. I'm not a death cross person, but okay. Maybe some downside to prior to the breakout level. That'd be interesting. GDX, maybe around the 31, 32 mark, starts to become a little bit interesting. On a relative basis, we're broken as well. And that's just fascinating to me because why? Why are we broken? Right? This is an environment where everybody's printing money. Gold should be working, and it's not. I have my theories. I think there's a faster horse that people are starting to pay attention to. So it'll be interesting to see how this plays out. I know I get a ton of questions about gold and gold miners all the time from clients, and I can't warm to it just yet. Not there. So going to keep paying attention to it. But in the meantime, better opportunities, especially if you're looking to play the inflation game. And we're going to watch Treasuries as well. As the market pulls back and as we look for oversold conditions above support, we'd like to see the Treasuries start to roll over. Now, we've seen some counter trend rallies in Treasuries. Now, so here's TLT. This is the think of this as the long end of the curve. That's a steady downtrend. We got a little bit of a rally here, but there's a lot of wood to chop to get through. So what I would love to see is I'd love to see the markets get towards oversold conditions above support. And I'd love to see these Treasury counter trend rallies start to fade. If I saw that, I'd have a lot of confidence to get aggressive on the long side of the portfolio. So I want to put it on your radar screen here today. And remember, the intermarket relationships matter. So take a look at that. That's going to wrap us up for today. Take us for a test drive, shakenanalytics.com/test drive. I'm back with you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.